$5 billion in lost orders. That's the financial blow U.S. ranchers took when ports across Asia slapped return to sender labels on entire shipments of American beef and pork. At the exact same time, Canadian meat packers quietly sealed a record-breaking deal worth almost the same amount. Now, Canadian beef, branded with the maple leaf, is showing up on menus everywhere, from Tokyo's Ginza district to Seoul's Gangnam Strip. Back home, the ripple effects were immediate. Ground beef jumped $1.90 per tray, bacon came dangerously close to hitting $10 a pound, and grocery store chains are already warning shoppers to brace for another 15% price spike before Labor Day. So how did Washington's tariff strategy backfire so badly that Canada, not Texas, is now feeding half of the Pacific Rim? And what does that mean for your next backyard barbecue? Tonight, we'll trace the path of every rejected steak, uncover the hidden choke points in America's meat supply chain, and reveal how a single government memo managed to put a $200 billion farm economy at risk. Stick with us until the end, because the final question could change the way you shop for food. Is the United States still in control of its own dinner table? The pivot started on March 27, 2023, when Tokyo quietly lifted a 20-year ban on Canadian processed beef. That move reopened a $518 million Canadian dollar gateway to Asia's wealthiest consumers. Fast forward 2 years, and by May 2025, Statistics Canada reported a 13.1% jump in meat exports to Japan. What started as a cautious reopening has now become a full-blown supply conveyor belt. News of Tokyo's sudden U-turn splashed across Asia's business headlines. Steakhouses from Osaka to Okinawa immediately swapped their U.S. prime chalkboard menus for Canadian maple leaf specials almost overnight. But this conveyor belt is being fueled by problems south of the 49th parallel. In April, Beijing rolled out a new 125% tariff on U.S. beef. As a result, major barbecue chains in China's capital city dropped Texas brisket from their menus in favor of more affordable Canadian cuts. Shipping containers once loaded with Nebraska choice are now returning to the U.S. half empty, while cold storage facilities across Asia are packed with red and white Canadian cartons. Industry lobbyists are sounding the alarm. They say that if Beijing allows hundreds of U.S. meat plant licenses to lapse this summer, the current backlog could spiral into a full-blown supply crisis. Upstream in Manitoba, cattle and hog producers are already treating the U.S. as a high-risk buyer. They're locking in deals with Korean and Filipino importers now, before Washington fires off its next tariff salvo. According to Reuters, some Canadian farms are even installing on-site chillers. This allows them to load products directly in Winnipeg, bypass the U.S. border, and skip every pending tariff or fee. If that workaround becomes permanent, American supermarkets could soon end up buying Canadian meat that once came straight from Iowa. It's proof that a single policy memo can completely reshuffle who feeds Asia's booming markets. On March 5, 2025, the U.S. Meat Export Federation reported that pork exports alone consumed 100.7 million bushels of U.S. soybeans in 2024, injecting $1.12 billion into American farm incomes. That same study revealed that meat exports added an extra 59 cents per bushel of corn sold last year. For many Midwest farmers, those extra cents were the difference between profit and loss, especially during a season of drought and sky-high fuel prices. But that safety net is starting to unravel. Since March 14, 2025, when Beijing hinted that licenses for nearly 1,000 U.S. meat plants could expire, Asian buyers have rushed toward Canadian suppliers, fearing sudden port shutdowns. It's a race against time. Chicago commodity traders estimate that if even half of those Chinese orders vanish, demand for U.S. soybeans could collapse by nearly 50 million bushels. That would erase nearly all the price gains farmers earned in 2024. And it won't stop with soy. Corn is next in line to take a hit. A 59-cent loss per bushel might sound small, but at today's acreage, that's nearly $3 billion wiped from the 2025 harvest value. Iowa co-ops are already seeing warning signs. With credit tightening, the potential drop in grain prices is flashing red across the Midwest. Meanwhile, Canadian ranchers are fielding long-term contracts that pay in Canadian dollars and guarantee space on ships bound for Asia, the same kind of deals that U.S. feedlots use to lock in without a second thought. If these agreements become permanent before the first frost hits, American grain elevators could be stuck this October with more soy and corn than they can sell. That could trigger a fire sale eerily similar to the 2018 tariff crash that farmers still haven't forgotten. Growers are already calling this the second punch after the meat supply chain knockout. And the worst part? It all started with meat boxes being turned away at foreign ports. The collapse of United States beef exports to China. How it's hitting America's wallet. This story, well, it revolves around three critical dates that highlight the sharp decline in United States beef exports. First, on March 27, 2025, USDA export data revealed a shocking number. Just 54 metric tons of United States beef were booked for China that week. That's a massive drop from the 2,000-plus tons per week the month before. So, what happened? Beijing let hundreds of United States plant licenses expire overnight. The result? A 97% collapse in exports that left Midwestern meatpackers in shock. The message from China was loud and clear. Find new buyers or stop production. Most United States beef producers just couldn't find alternatives fast enough. Cold storage facilities became overwhelmed. Supply chains stalled, containers sat idle incurring demurrage fees, and some meat plants started canceling slaughter shifts to avoid deeper losses. Meanwhile, American consumers started feeling the effects almost instantly. By February 28, 2025, the average price of ground beef in United States cities had jumped 43% compared to prices in early 2020. For example, a family that used to spend $8 on taco night 5 years ago now pays nearly $12. This kind of sticker shock, hits hardest in low-income communities, where pork and beef have traditionally been the most affordable sources of protein. Even school lunch programs are adjusting, replacing beef with cheaper chicken to stay within budget. Why can't supply catch up? The national cattle herd is at a 74-year low, mostly because of drought-driven culls. Feedlots are running thin, replacement herds are scarce, and even Tyson Foods says it's losing money while waiting for ranchers to rebuild. But rebuilding herds is not a quick fix. It takes 2 springs, not 2 financial quarters. Canada steps in. A new trade opportunity. Canada sees opportunity in this crisis. With China rejecting American beef, Canadian packers are ramping up production. In Manitoba, slaughterhouses are adding double shifts, and in Saskatchewan, rail yards are stacking up refrigerated containers to ship more meat abroad. Even Japanese importers are acting fast, paying extra premiums to secure next season's quotas before Washington can respond. The longer the United States licenses remain suspended, the more Canada cements its position in Asia's beef market. If Beijing extends the block in July, analysts predict the United States could lose another $1 billion in beef exports by the end of the year, and tariffs won't be enough to reverse that loss. The domestic ripple effect: beef prices soar. The export crash isn't just an issue for ranchers and exporters, it's now hitting everyday shoppers hard. At its May 5, 2025 investor meeting, Tyson Foods reported an 8.2% increase in average beef prices for the second quarter. The announcement sent consumers rushing to cheaper chicken and caused Tyson stock to plunge 9% in a single day. Retailers face a tough choice: either absorb higher costs or pass them directly to customers. Evidence of the squeeze came fast. Tyson executives openly admitted that rising cattle prices are crushing profit margins. Consumers, meanwhile, are pivoting to more affordable chicken, creating fresh challenges for Tyson's recovery plan. Their CEO called the current market the toughest we've ever seen. Wall Street took note, and it hasn't forgotten. Why is this happening? The root of the problem is simple. The United States cattle herd is the smallest it's been since 1951, according to Reuters. Feedlots are bidding aggressively for every available steer, causing wholesale beef prices to skyrocket. In fact, by May 2025, wholesale beef was already 10.1% higher than the same time the previous year. And for American families, that increase is now showing up in grocery bills. Sometimes one decision can send shockwaves across an entire industry. That's exactly what happened in early 2025, and the ripple effects are still unfolding today. Let's break it down. 3 key dates define this massive shakeup in America's beef market. The first shock, March 27, 2025. On March 27, 2025, the USDA released its weekly export report. The numbers stunned the agricultural world. Only 54 metric tons of United States beef were booked for shipment to China that week. That's not a typo, just 54 tons. To put this into perspective, just 1 month earlier, China had been buying over 2,000 tons of United States beef each week. So what happened? Beijing quietly let hundreds of American meat plant licenses expire overnight. No warnings, no negotiations. Just a sudden move that left American exporters scrambling. The fallout Midwest packers hit hard. This decision triggered a 97% collapse in United States beef exports to China. For meat packers in the Midwest, this wasn't just a policy shift. It was a disaster. The message from Beijing was blunt: either find new buyers or park your trucks. But for most U.S. packers, finding new customers isn't something you can do overnight. Export contracts take months, sometimes years, to negotiate. As a result, freezing plants hit capacity almost immediately. Cold storage chains stalled. Demurrage bills, fees for delayed shipping containers, began piling up. And in a last-ditch effort to cut losses, many meat processors started canceling slaughter shifts altogether. This wasn't just a problem for the exporters and packers. It soon became a problem for everyone buying beef in the United States. Rising prices, the pain hits home. By February 28, 2025, average ground beef prices in U.S. cities had already surged by 43% compared to early 2020. Let's put that into everyday terms. A family that spent $8 on taco night 5 years ago is now paying nearly $12 for the same meal. For millions of Americans, especially those in low-income neighborhoods, this is a crisis. These are the communities where pork and beef once stretched grocery budgets the farthest. Now, with prices rising fast, many families are forced to pivot to cheaper protein options, like chicken. School lunches feel the pressure too. Even school lunch programs are making adjustments. Many school districts have started rewriting their menus, swapping out beef in favor of less expensive chicken. This isn't just a temporary fix. If beef prices stay high, nutrition programs across the country will have to rethink how they feed students for the long haul. Why can't supply meet demand? One obvious question is, why can't ranchers just produce more beef? Well, the problem is, the U.S. cattle herd is sitting at its lowest level in 74 years, the smallest since 1951. Years of drought-driven culling forced ranchers to sell off cattle early. Feedlots are now thin, replacement herds are scarce, and building the numbers back up isn't something you can fix in just a few months. As Tyson Foods openly admits, this process takes 2 springs, not 2 financial quarters. That means even if ranchers started today, it would take at least 2 years before new cattle are ready for market. In the meantime, meat producers are bleeding money. Even giants like Tyson are struggling to stay profitable while they wait for the ranching sector to recover. Canada steps in, a new player on Asia's dinner plate. While the U.S. struggles, Canada is seizing the opportunity. Every ton of beef that China rejects from the U.S. is a direct invitation for Canadian producers to step in. In Manitoba, meat packers are scheduling double shifts to meet demand. In Saskatchewan, rail yards are stacking refrigerated containers, preparing to ship more beef to Asia. Even Japanese importers are getting in on the action, paying premiums now to secure next season's quotas before Washington can respond. What happens if the ban continues? If Beijing renews the block in July, the consequences will deepen. Analysts warn that the U.S. could lose another $1 billion in beef orders by the end of the year. And here's the harsh truth: tariffs won't fix this. Once a country like China builds new supply chains, whether through Canada, Australia, or South America, it's incredibly hard to reverse those trade routes. The impact is now hitting American shoppers directly. At its May 5th, 2025 investor briefing, Tyson Foods revealed that beef prices jumped 8.2% in just the second quarter. That news triggered a consumer shift toward cheaper chicken, and Wall Street reacted fast. Tyson's stock plunged 9% in a single trading session after the announcement. Retailers are caught in the middle. They either swallow the higher costs, which cuts into profits, or pass the price hikes directly to customers. Tyson's CEO summed it up clearly. "This is the toughest market we've ever seen." That line stuck with Wall Street, and for good reason. According to Reuters, the U.S. cattle herd is at its smallest since 1951. Feedlots have no choice but to bid aggressively for the limited supply of steers. That bidding war is driving up wholesale beef prices, which then show up in consumer prices at the supermarket. By May 2025, wholesale beef was already 10.1% more expensive than it was a year earlier. We're now seeing the steepest surge in staple protein costs in recent memory. From Dallas to Detroit, fast food chains are shrinking burger patties, while grocery stores scramble to update shelf prices almost weekly. In school cafeterias, beef tacos are quietly being swapped for chicken. Why? because school budget directors are stuck chasing invoices that rise faster than government reimbursements. Meanwhile, across the Pacific, diners in Tokyo and Seoul are cutting into steaks labeled Canada Prime. Those cuts used to leave from Seattle's ports, but now they're bypassing the U.S. entirely, heading straight from Canada to Asia. Every pound of beef Canada ships abroad tightens the supply gap on American store shelves. Experts are warning, if this drought drags on and tariffs remain, the classic holiday roast could shift from tradition to luxury by the fourth quarter. To put it plainly, Washington's trade strategy has turned into a new kind of grocery tax, and the clock's still ticking. But don't go anywhere, because in the next section, we'll break down what happens when soybeans, corn, and feedlots collide, and why the final bill could make today's prices look like a bargain. The meat price crisis you're seeing at the grocery store is just the beginning. As U.S. officials keep arguing about tariffs, Canada is already moving full speed with a new strategy that could permanently reshape North America's meat supply chain. On February 28, 2025, Reuters reported that 75% of Canadian beef usually goes to the U.S. But now, ranchers across the Canadian prairies are cutting their herd sizes instead of rebuilding them. Why? Because Washington keeps threatening a 25% border tax. Producers say they won't risk raising calves if there's a chance their largest customer, the U.S., could suddenly close the market overnight. On March 7, 2025, Ottawa responded with a bold move, a $6.5 billion Canadian dollar relief package. This includes $1 billion earmarked for new cold storage centers and refrigerated rail routes, allowing Canadian meat packers to ship beef directly to Asia without ever crossing into U.S. territory. Subsidized steel and extra-long freezer cars are already lining up in Saskatchewan rail yards, offering Japanese importers a door-to-door option that never even touches the 49th parallel. Meanwhile, Washington's response has been grim, aggressive cost-cutting. On December 2, 2024, Tyson Foods announced it would close its beef and pork plant in Emporia, Kansas, cutting over 800 jobs. It's the latest sign that weak demand is forcing U.S. meat packers to scale back from 3 daily shifts to just 1, or even none. Industry insiders quietly warn that if China keeps its current license freeze in place past August, at least 4 more Midwest processing lines could shut down by Thanksgiving. This looming threat has Iowa feedlots refusing to buy new cattle, while Minnesota's grain elevators are now chasing offshore buyers to unload an impending corn surplus. The contrast between the two countries is striking. Canada is busy subsidizing conveyor belts and infrastructure to scoop up orders rejected by the U.S., while America is closing slaughterhouse doors, hoping tariffs will somehow reverse global trade flows. But unless U.S. policy changes soon, Canada could lock down the Pacific Rim protein market, leaving American ranchers watching their best calves priced out of both export and domestic sales. Imagine this. Christmas lights flicker on, and the supermarket meat section no longer carries a single product of USA label. That's not an exaggeration, it's the current trajectory. Canada captured Asia's market by moving faster, building larger freezers, and branding itself with a red and white label that the region now trusts. Meanwhile, Washington got bogged down in paperwork, allowed cold chain infrastructure to decay, and fired a tariff shot right into its own foot. If Capitol Hill can't fix the logistics bottleneck and align food safety standards before the next buying cycle, America's $200 billion protein empire could melt away, losing a century of dominance in just 1 fiscal year. Yet there's still one potential lifeline, a North America-Asia standards pact that would streamline the rules and move meat at Canada's speed. So here's the big question. Will the Stars and Stripes fight back for your Friday night steak, or will the Maple Leaf keep setting the table? Drop your predictions below. Your comment could inspire next week's headline.